Hello friends, welcome to Prepper. So in this particular course, I'll be starting with monetary policy, which happens to be the second leg of public finance. So we are going to begin with the first part on monetary policy, which will be important for your examination. So let's start with the first part. But before beginning with the first part, be very clear as to what exactly monetary policy is and under which leg I'll be studying it. So there is a parent topic by the name of public finance. Public finance is the parent topic. There are two legs within public finance. First is fiscal policy and the second is monetary policy. Fiscal and monetary policy. Fiscal policy is in the hands of government, whereas monetary policy is in the hands of central bank, and this is true for any country. So every country has fiscal policy which is in the hands of government and monetary policy which is in the hands of central bank. So the job of both these organizations or both these entities is basically to control or rather regulate the money supply in the economy. Money supply in the economy has to be regulated. Regulation means increase or decrease. So, for fiscal policy, you should view the course on fiscal policy. For monetary policy, you should view this course, which is the monetary policy course. And monetary policy is in the hands of central bank of that country. In India's case, it happens to be the Reserve Bank of India or the RBI. So let's understand what exactly is monetary policy. Monetary policy, as I've told you, is in the hands of central bank of the country, and the main job is to regulate money supply in the economy, which means increase or decrease in money supply. So monetary policy can be defined as the process by which the monetary authority of that country, I repeat, monetary authority, which happens to be central bank of that country, which in case of India is Reserve Bank of India or RBI, controls the supply of money. I repeat, controls the supply of money. Control means regulation of money supply. Control does not always mean to reduce it, but control the supply of money means regulate it. Regulation means either increase or decrease the money supply in the economy. So this is in the hands of central bank of the country, and that is something which is dictated by the monetary policy of that country. So why does the central bank need to regulate the supply of money? It often targets two things. It targets the inflation rate in the economy, or it also targets the interest rate in the economy. So if the inflation is too high, it would control or regulate the money supply, it would reduce it so that inflation also reduces. If it wants to control the interest rate, increase the interest rate or regulate the interest rate in order to control inflation. So inflation is controlled also by the rates. That is also done by the central bank of this country. So it targets both of these things in order to stabilize the money supply in the economy, to ensure price stability and general trust in the currency. So whatever currency you adopt, in that case it has to be stable, and that stability can only be ensured if central bank makes sure that money supply in the economy is regulated. So that is what monetary policy is. So monetary policy is maintained through actions such as what all does the central bank do in order to maintain the monetary policy? It modifies the interest rate. By interest rate, what is meant? It modifies the interest rates like repo rate, reverse repo rate, it modifies bank rate, it modifies all these things. So when you modify means you increase or decrease these rates in order to control the money supply. So it would modify the interest rates, it would buy or sell government bonds, like it would issue government bonds and it would use the government bonds. Now don't get confused over here. Government bonds does not mean that the government bonds directly issued by the government. Whatever government bonds that were issued by the government have been purchased by RBI. Now if RBI is using the government bonds for people in order to reduce or increase the money supply in the economy, it is considered to be an RBI action or a central bank action. It is not considered to be a government action. So if the government bonds are issued by the RBI or issued by the central bank of that country, in that case it would be considered to be the monetary policy instrument. Changing the amount of money banks are required to keep in the vault, bank reserves. So this is what SLR, statutory liquidity ratio, CRR, cash reserve ratio. So if cash reserve ratio was 5%, it will be increased to 6% if central bank wants that the ratio to increase. Similarly, if they want ratio to decrease, it would vary the same. So these are the modifications that the central bank would make. And in order to make these modifications, what would it do? It would regulate the money supply in the economy. So modifying the interest rates, buying or selling government bonds, changing the amount of money banks are required to keep in the bank reserves. All these things are required in order to regulate the money supply in the economy. This is what monetary policy aims. This is basically the aim of monetary policy, or the objective of monetary policy. So monetary policy is, in one single line, controlling or regulating the money supply in the economy. How can that happen? It can happen by all these three things that we have done. So let's look at a graphic about monetary policy. There are two phases of monetary policy. The first phase is that you have to adopt a type of monetary policy that would increase, or that would, rather, you can say, you would make the inflationary tendency high. Inflation would go up, means the money supply in the economy would go up. Now please understand one single logic over here. Let me explain it to you. If the RBI wants money supply in the economy to increase, it can only increase if RBI adopts something known as a loose monetary policy or an expansionary monetary policy. So in this case, the RBI would make the borrowing easy, which means people can borrow funds easily from the banks. Consumers can purchase more, it can buy more. So they can buy more only if there is money supply in the economy which is excessive. Businesses expand, more people are employed, people are able to spend more. So all these things contribute towards more money supply in the economy, and then the money supply in the economy increases, it leads to some inflation also, because demand is high and the supply is less. So in that case, it would increase the money supply, it would increase the inflation. This is called as loose money policy. And a tight money policy, it means that the RBI would not want excessive demand in the market. So it would make the borrowing difficult. You can't borrow much funds from the banks. Consumers would be able to buy less because money supply in the economy would be less. Businesses postpone the expansion because they are not getting easy access to loans. Unemployment increases because you don't get much jobs, as employers are not able to sell much, they are not able to generate much money. Production is reduced. Hence, there is a recessionary tendency in the economy. That is called as tight money policy. I would be explaining these two terms as EMP, expansionary monetary policy, and CMP, contractionary monetary policy, in the upcoming parts of this video. So please subscribe to our course in order to get access to all the videos of these awesome topics prepared by us, Prepper. Thank you so much for watching this video. Bye.